all right, we're pushing new all-time highs on the market, but a lot of people are probably asking themselves, is the market going to crash? Why doesn't the market crash? What's happened? We haven't seen crashes in, I don't know, a long time, right? We've seen some pullbacks in 25 and 2022 and a little bit earlier this year, but we haven't seen a crash in ages, right? Since like 2008, 2009. Well, today we're going to be watching this video called Why the Stock Market Refuses to Crash. Now, I am a professional investor competing in the US Investing Championship, and I want to know, why has the market crashed yet? Let's watch this together.
Hear me out here. The Strait of Hormuz has been closed for several weeks now. The US Navy blockade is still ongoing. And this has caused an oil shock of massive proportions. I'm talking millions of barrels per day being disrupted, and that has caused the price of oil to skyrocket all around the world. But it's not only oil, it's also critical materials like fertilizer and helium that are disrupting supply chains around the world. And that's why some people have said that this whole thing could lead to a global recession. But
well, I mean, there are some knock-on effects that I don't know if the grand scheme was really talking about. So for one, Spirit Airlines just shut down over the weekend. Thankfully, I don't fly Spirit. But when I was booking my flights, Spirit came up as one of the options. And I was like, yeah, I'm not flying that. But they just shut down. They didn't tell anybody what was happening. All the customer service got turned off. They literally just shut the doors. And I think that they were operating on such tight margins that with the fuel costs going up from the Strait of Hormuz, that was it. Game changer. It's done. That was not intentional, right? I don't think Trump set out to, I didn't set out to close Spirit Airlines, but they were a terrible airline anyway. If they were a good airline, they wouldn't have had all these problems. Whatever, right? So there are definitely some knock-on effects.
When we look at the stock market, it just V reverses to new all-time highs. And not only that, it does so at a record rate. Just check this out. The S&P 500 in the past 10 days is in the 99.7th percentile of all 10-day returns.
So I do want to point this out because a lot of people look at a chart like this and they're like, this is a third standard deviation return. A third standard deviation return only happens 90. No. Anything that's not a third standard deviation return happens 99.7% of the time. So this is in the 0.3% of the time. That is why a lot of people say the market can't do what it did, but it did. Why are you going to be the person standing on the other side of this saying, oh, it has to go down. It should go down. Who cares what you think it's going to do, right? And I'm not saying that he's saying this. What I'm saying is a lot of people get this mistaken and they say, well, it can't do that. It can. It totally can. Absolutely can.
This is absolutely insane. And it's not only this time. There's so many other times. Just look at this. The market has V reversed off of crazy events like tariffs, like COVID, and a bunch of other ones that I've circled here. It really feels like the market just refuses to stay down. So what I'm wondering is it impossible to have a sustained crash or bear market anymore? Or is the market literally just going to go up only forever? Well, my friends.
Well, I do think that a lot of the reason that the market goes up the way that it does, up and to the right. Now, this is not every stock. This is the market itself, the S&P 500, basically. The reason being is, in my opinion, the rise of passive investing, right? For how many companies, like probably 99% of you have some sort of company sponsor 401k or maybe even an individual IRA that you contribute to on a recurring basis. Where do you think that goes? It's money that wasn't in the market going into the market. So it pushes the market up higher. Now, the real question is, and this was in one of the Robert Kiyosaki books. I forget which one, but I remember reading it and I was like, this makes sense, but I haven't seen it yet. I forget which book it was, but he talks about the impending crash with baby boomers who are going to leave the workforce and then start drawing on that retirement. Because they're no longer being net contributors. There'll be net distributions coming out of the market. I don't know if that's true or not, but I'm very curious. Very curious.
I'm Kevin. I'm the curious retail investor, and I've been investing and studying markets for 8 years now. Now, I know that's not a super long time, but I'm the type of person who always does my own deep research to figure out what to think for myself. And when I did my research for this particular topic, I found some fascinating explanations and theories as to why the market is acting in this way. And there's also some super important and actionable takeaways for all retail investors. So you're going to want to watch this video until the end. Now, in order to answer those questions that I just posed, I want to first start specific with this most recent Iran war and Strait of Hormuz event, because this particular oil shock had people spooked. And for good reason, right? This Strait of Hormuz handles millions of barrels per day and accounts for roughly 20% of the world's oil supply. And historically, when we look at oil shocks in the past, they've all led to major recessions and major market crashes, right? Like every single one of them. You can just see this person wrote it out nicely for us. So a lot of people were scared and they were like, this is going to happen with us this time around too. But we got to be nuanced, because when we look at how things stand today, they are quite different. First and foremost, we have the Saudi Arabia's East-West pipeline filling part of the gap, right? They're just diverting the oil to the other side. And then you see here, we have super tankers going to the US Gulf course to pick up some oil and then deliver it where they need to. So this is a huge thing, right? Because if you look at this chart, the US has become a huge exporter of oil over the past few decades, right? In 30 years, the US went from energy prisoner to energy landlord.
USA, USA, USA. They're all coming to Texas, baby. That's right.
And you can see the timeline here about like fracking, export ban lifted, et cetera, et cetera. But point is, all those times we had major recessions and major crashes in the past due to oil shocks, that was when the US was in a totally different state from today. And now, like we saw with the diverted supertankers picture, the US is actually benefiting from this whole crisis. But point is, like the markets are treating this whole thing as a bounded event. And we always hear that the market is forward-looking, right? So right now they're pricing in the least bad outcome. And given what's happened today, it looks like the market was smart and got things right. But anyhow, that explains why the market didn't have a sustained correction this time around. But what about all these other times in the past few decades, like ever since 2008? Like, why hasn't there been any sustained correction or major bear market besides maybe like 2022 when the Fed raised rates? Look at all the other times. It just V'd back new all-time highs in the blink of an eye. So why is that? Well, my friend, this is where things get super interesting, because I found several explanations for this behavior, some of which.
All right. Well, that was a good video. You know what? Thank you so much for watching, hanging out with me today. If you're ready to save time, make money, start winning with less risk, click one of these two, and we'll talk soon. Wait, what? Just as he's about to get the answers, he ends the video? No, I'm just joking. I'm just joking.
Which makes a lot of sense, and some of which I did not know until I came across it. So let's go through them one by one. There's 3 in total. Now, the first one is very obvious. It's the Fed put. And basically, that's like if things get super bad, the Fed will come out and save us, like lower rates, print money, whatever. Now, this is actually quite funny because one of my favorite macro podcasts by Blockworks, it's called Forward Guidance. This is exactly what Tyler said a few days before the market started recovering to new all-time highs. He was like, maybe things are so bad that the market is already anticipating the policy response, right? And that kind of encapsulates this whole Fed put idea beautifully. But also this is a real thing, because if you look at this, Wall Street is too big to fail. US financial assets over 5.4x of GDP. And this is an old chart. It's like 2020. Not only that, but the amount of household exposure to the stock market is higher than during the dot-com bubble. So we always talk about like Main Street is struggling, but Wall Street's doing good, whatever. But Wall Street is Main Street these days. They're one and the same. So if we ever had a super bad bear market, that would affect so many things beyond just Wall Street. Then that's the whole point of this Fed put. But anyhow, the second explanation for why we can't have a sustained bear market.
This is my theory. Now, I have not watched this ahead of time, but this is my theory.
Market is because of the rise of passive investing, right? You see here, it's almost 60%. It's more than active these days. And that just means
So when I worked in corporate finance, so for those of you who don't know, I did 3 years at Raytheon. I was a financial analyst on the Predator and Reaper drone projects on the missile targeting system. It's a little ball that hangs down underneath the drone. Then I did 1 year in Irving, Texas at Union Standard Insurance in financial planning and analysis. And then I did 12 years doing consulting with credit unions, showing them where to make more money and have less risk on their balance sheet. So finance bro from the start here, okay? During that time, I don't know how much I contributed to my 401k, but a good amount, right? multiple six figures, and every chance that I could get employer matching, you better believe I did it, right? So let's say if I put in 10% and the employer matching was 5%, that's 15% of my income that goes into the market every single year, right? And let's say you're making $100,000, that's $15,000 going into the market every year that you wouldn't have had elsewise going into the market every year, right? Now imagine that spread across not just one guy, but the entire finance industry. Just for example, we're probably talking about $1 billion a week. You talk about every industry out there, everybody who has 401k, we're probably talking about multiple billions of dollars, maybe tens of billions of dollars every week going into the market. That, my friends, is that passive investing rise that you see right there.
Paycheck, part of it goes into the stock market. Doesn't matter what price it is, if it's up, if it's down, doesn't matter. It goes in like clockwork. And this person wrote it perfectly. Like a big swath of the market is now price insensitive. So these are buying.
Absolutely. Yes, exactly. Because when you are investing in a 401k, and you know this, I'm not telling you anything new. They're literally just taking, you never even see it, right? Especially if it's pre-tax, right? You never even see it. And it doesn't matter what the price is. That's just what you're going to buy it at. And I remember when I do my consulting thing, all the other consultants, we would get an annual statement, a paper annual statement that the HR people would drop off, and everybody rip it open and be like, okay, how much did you earn? How much did you earn? And it was always a competition. But at the end of the day, all it was which mutual fund did you pick that got your got your assets handed into it, right? That's it. That is the only thing, right? Oh, you did better than me because you picked a different asset than me, right? Your target retirement date of 2050 or whatever did better than mine. That's it. And because of that, all of us, even though we worked in finance, were completely price insensitive because we couldn't do anything about it. It was, here's your list of investments, pick one of those and stick with it for the next 50 years. That's it.
No matter what. And that, if you think about it, that's clockwork like demand keeps the market from going down and staying down for too long.
The Baja Beach Bum says, Gemini says $4.4 billion a day goes into passive investing. Yeah, exactly. That's what I'm trying to get at here, right? $4 billion a day goes into the market. And you wonder why the market goes up, right? Let's switch to monthly candles. $4 billion a day goes into the market. Now, I have no idea how much comes out of the market, but that's why it looks like this, up and to the right. And that's why finance people will tell you, don't worry about any sort of pullback. It always goes back up, right? Your Edward Joneses, your financial advisors, just don't worry about it. Just put money in. It always goes up. And it kind of makes sense when $4 billion a day goes into it. It always goes up.
So those are two things. But now this next one is super fascinating to me because I did not know this before. And this is the change in market structure, or to put.
Before he gets into that, you only get paid if price increases. Okay, so let's look at this. Let's no more FOMO. You got a great point. Imagine if $4 billion a day goes into the market and the market's going down. Okay, let's play this out. Why does the market go up? It's an imbalance of fear and greed. Okay, there's more greedy people out there who are wanting to invest so they have more money later. Imagine if $4 billion went into the market every day and the market goes down. Do you think people would want to invest anymore? Of course not. Of course not. They're not going to invest anymore. So if the market starts going down, people are going to be pulling their money out. Therefore, there's no longer going to be $4 billion a day going in. It might be $4 billion a day coming out, and it's a self-fulfilling prophecy, right? That's what turns in. That's how the market cycle works on every stock out there, right? On every stock. And if we go to something like Tesla, and we go to the daily candle so you can see this easier, you can see the market cycle right here. Stage 1, 2, 3, 4. We can go to SoFi. Stage 1, 2, 3, 4. We can go to Microsoft. Stage 1, 2, 3, 4. It's because they're not getting the $4 billion a day. These are individual people who are like, oh, you know what? When I invest into Microsoft, I'm a boomer. When I invested into Microsoft, it only went up. But now Microsoft only goes down. I'm not going to put my money in there anymore. Okay. So where I'm saying is that if we imagine a market that isn't always going up, then there wouldn't be investors putting their money into the market to make sure the market always goes up. This is how it works. Okay. Now, it's oversimplified, of course, but it's exactly this. Hold on. It's exactly, I have a slide for this. It's exactly this. Let me zoom out just slightly. Sorry. Right. When people get scared and the market's going down, they're all going to scream sell. When people are excited and the market's going up, they're all going to scream buy. Once the market stops going up, and the people who are putting $4 billion a day to work in the market, they're like, oh, you know what? If the market's not going to go up, I'm not going to put my money in it. So there will have to be a fundamental break, a huge break in the system in order for that to happen, because so many people are there pushing the price up.
Put it better, the different participants in the market. You see, there's a new layer of mechanical buyers in the market that kind of dominate price action. You've got the trend following funds, or CTAs, and they manage over $350 billion. And they basically just follow the trend, whether it's up or down. Then we got options dealers hedging trillions of dollars worth of derivatives. Together, they create automatic dip buying. Here's how. So for the CTAs, when the volatility spikes, they reduce positions and eventually the selling exhausts itself. But then once the price stabilizes, their models detect a new uptrend, they flip to systematic buying, and then the buying leads to more buying, which is what helps the V shape go back up. And this post is super recent from this week. Basically, it says that CTA...
I can't see that either. Before y'all just throw that in the chat, I literally, like, it's just slightly less black on black.
Are expected to purchase $85 billion in global equities this week, the largest systematic buying flow in the past 10 years. Such a mechanical inflow could generate a notable short-term upward push driven purely by algorithmic portfolio rebalancing rather than by any fundamental catalyst. So case in point, these trend-following CTAs are helping buy the dip. On the other hand, we have these option dealers that are typically forced to buy when prices fall and sell when prices rise just to stay hedged. So this mechanically creates mean reversion and keeps things from falling too much, you know? And the point here is that these players did exist in the past, but now they've grown so much that they fundamentally changed how the market behaves. Also, the rise of zero DTE options, which are basically daily expiry options, also...
Zero DTE options is essentially legal gambling on the stock market. Legal gambling on the stock market, zero DTE options. Yeah, you're not going to see me ever do that.
Change things because the gamma positioning that these dealers care about, it now resets every single day. So the market has a fresh chance to stabilize after any given sell-off. And here's the 0 days to expiration options. And here you can see the rise of it. Like, this is a little old, but over the last 3 years, the volume share of these risky trading instruments have more than doubled. And now they're pretty much dominating the markets. So the net effect of all this is that corrections are violent but self-limiting. Recoveries get reinforced by mechanical buyers stacking on top of one another. So in order to get a...
Recoveries are reinforced by mechanical buyers, right? That's your passive investors. That's the people who are out there week after week after week contributing to the market because they are completely price insensitive. And so therefore, when a sell-off happens, it means nothing to them whatsoever because they're just piling their money right back into it. You would have to be overwhelmed by all the flows simultaneously, which is rare. That's what I'm saying, right? Dude, I'm totally tracking with what you're going on over there, okay? Y'all be sure you subscribe to Kevin Ting's channel. I'll subscribe as well.
Sustained crash or a sustained bear market, you would need to overwhelm all of these flows simultaneously, which is quite hard to do, is the point. And this is really crazy, right? Because I knew like the Fed put and the passive investing stuff, but this market structure stuff, these new participants really brings it all together and helps explain why we've seen what we've seen for the better part of a decade. But does that mean that bear markets are impossible these days and we should just all be max long? Well, hold up, my friend, because that would be a very irresponsible conclusion. And if you know me, I always like to look at both sides. So I also looked at the counter arguments and found some really interesting stuff that we all should consider. Like first, for this particular crisis, we're not out of the woods yet. I mean, yes, they had the ceasefire and the Strait of Hormuz reopening, but you know how things change like by the hour. So we'll see if that holds. And if things re-escalate like a ground invasion or the fragile ceasefire breaks, then maybe things will just as easily crash back down. So that is possible, is my point. But more generally speaking, the Fed put does have an Achilles heel or an off switch per se. And that's inflation. Like if inflation is too high, they can't really lower rates or print that much unless they want hyperinflation. But more specifically, it's the bond market that kind of limits the Fed, because the Fed can cut their short-term interest rates all they want. But the bond market, it's what sets those longer-term interest rates that affects things like mortgages, et cetera. So these long-term interest rates is what actually matters. And if the bond market doesn't believe that the Fed has a handle on inflation, they can just refuse to buy these bond notes, and then the price is going to go up more. Then it's just basically going to undo the Fed's rescue. Now, the third thing is that the passive flows that I talked about could stop or even reverse, because these passive flows largely come from 401k contributions from people's jobs. But if
That's what I said.
unemployment gets worse, or if the job market gets worse, then these could slow down or even reverse if people have to sell some of it to pay for bills, right? And also the boomers are retiring a lot in the
That's also what I said.
coming years, and they will need to sell from their portfolio to fund their retirement and fund their lifestyle, right? So the passive flows, this could also be a big reversal point. And this is actually potentially a very interesting side topic that I should make an entire video on, like when will these boomer flows reverse? If you want me to cover that topic, let me know in the comments below. But yeah, overall, I think my takeaway is that, this system does have an off switch, and we got to keep our eyes on inflation and the bond market response. But also, not every correction is a bear market, right? Like, we need to ask if it just is a short-term sentiment shock, or if there's actually something structurally broken, right? And then when we talk about the structural bid, this is largely a US thing. So if it, for some reason, breaks, then we as retail investors can look elsewhere for opportunities. Like we can look to international markets, commodities, hard assets, and things like that. But anyhow, folks, this topic was really a burning question on my mind of whether...
Dude, I like it. You guys go subscribe to Kevin Ting's YouTube channel. This is great. I definitely want to watch another one of his videos in the future. But yeah, what a fantastic title. Why the stock market refuses to crash. And I think he did a great job covering that topic, right? And listen, if you're ready to save time, make money, and start winning with less risk, click one of these two videos, and we'll talk soon.